Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist of WealthPress. You might or you might have not noticed that I'm not in my usual studio. I'm actually in Orlando with my family for Universal Studios. I'm actually going to be leaving in about 4 or 5 hours, heading back home. I've been here since Wednesday night, I believe. Days just get away from me. Anyhow, wanted to give you guys a good little market update. Wanted to make sure you had all the information you needed. Now, markets are starting to open up lower and head higher as the day goes on. That is a very significant sign that market dynamics are changing. That's one of the factors. Another factors is, and I hate to say I told you so, but remember somebody by the initials of RS talking about semiconductors, chip stocks breaking out? Well, guess what? They actually broke up higher. Look at NVIDIA yesterday. Let me show you this. Take a look at this. This is very, very bullish because chips are the heart of everything. We can't make tech beat without chips. Look at NVIDIA. NVIDIA rallied yesterday almost 7%, and it's almost at a good month. Let's see here. Almost at a 1-month high. Now, here's where things get really interesting. If you look at ADI, which is another chip stock, this is one of the ones I was talking about. Look at where we're at. We're literally at the 200-day moving average. So if we can go above these levels, this will be very, very bullish for the entire tech sector. Now, with that said, when I was looking at the stock market over 5 days, look at the 3 sectors that are leading right now. You can't make this up if you tried. Consumer discretionary, it's a little early still here to talk consumer stocks, information technology, and communication services. That's over 5 days. And yesterday, as well, on Thursday, consumer discretionary, basic materials, communication, information technology. My point being is things are definitely changing. And if you look at my CSI scan, look at where communication services is now on a monthly basis. Remember when it was the last spot? Well, now it's the 3rd spot. On a cumulative basis, it's still lagging behind. It still has a while to go. But on a monthly basis, this thing has been rocking and rolling. I mean, you still have energy utilities, but communication services being in 3rd spot, that's the sector that's been lagging behind. That's very, very significant. As far as data today, we've got the unemployment report. We're looking at 3.5 to 3.7%. I wouldn't look at the actual number too much because as you could see here, it's all over the place, 250,000 to 370,000. I mean, that's like 50% range. Consensus, hopefully, is about 325, 370, but I'm more looking at the unemployment number, the percentage, and that's pretty tight. It's between 3.5 and 3.7%. I'm hoping that the number's on the lower end of the range, but we shall see. But at least there's some certainty here, or at least some closeness as to the number. So I would be looking at the rate, and that's coming out in about 40 minutes. Now, as I mentioned, the market's a little lower right now, but let's talk about global economy because markets have been getting more choppier and losing volatility. Let me show you what I mean exactly. This is the Dow Jones. This is actually really important. I want to show you this. This is significant because you could look at every possible technical indicator in the world, but one of the most important factors to look at is volatility on a 10-day basis. If you look at the volatility on a 10-day basis, look at what's happening. We were at 750 points on the Dow. We're now at 630 points on the Dow. It's significantly lower, but notice volatility is cooling off. The more volatility cools off, the better it'll be for these prices. And if we can break to this 340 level or 34,000 level, it would be very beneficial and put us right near the 200-day moving average. And as I said many times, if we can bypass the 200-day moving average, we're back to new highs. Also, we're having divergence right here with the RSI and all of the other things that I have mentioned. Now, let's talk a little bit about global economy. Not too busy of a week. Remember, it's been a fragmented week. A fragmented week is a slow week. We had one of the 4 major holidays or 3 major U.S. summer holidays. So we had Monday off, and that rolls into the remainder of the week. Typically by Thursday or Friday, we start going back to normality. But again, with Monday off and it being summer, large funds are going to come in next week. Again, it's hard to speak so early in the morning, so fast. Market players are closely watching U.S. non-farm payroll, employment data later in the day, and a slew of economic data on Japan next week, OPEC meeting on Thursday next week as well. Japan and U.S. signed a revision of a beef safeguard mechanism. Remember, where's the beef? Under the U.S.-Japan trade agreement, which will help American beef producers meet Japan's growing demand for high-quality beef. That'll be very interesting to see what happens there. Trading has been choppy. It's been very choppy in recent days as investors are worried about inflation and economic interest rates. It's a balancing act. And then now the Fed comes in earlier this week and starts talking about possibly taking a little break in September and not raising rates. Meanwhile, high inflation is eating into corporate profits while the war in Ukraine and COVID restrictions in China have weighed on the markets. The bottom line is, folks, we need to meet certain levels. A few positive signs. Volatility via the VIX finally broke that support level. I keep saying resistance. That support level to the downside. This is very significant if volatility comes lower, and I'm expecting volatility to come lower over the next 3 or 4 days. Expect the market to go higher. In terms of the sectors that I'm watching right now, honestly, keep your eye on the QQQ and the chip stocks. They're right now leading ahead of the market once again. Notice this breakout. Notice if this goes up to 330 level on the SPY and on the SMH. Watch those chip stocks right now. They're very, very, very important because they're starting to lead the market. Watch for this breakout in chip stocks taking us to the 200-day moving average. We're right now at about the 250 on the SMH. That's the semiconductor ETF. If we can go to 270, that would be very, 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 very bullish. Now, this week has been very fragmented. We've had earnings. We've had a lot of things going on. We've had retail earnings. But the most important factor is the fact that small caps, like the Russell 2000, are starting to make their move. Remember, this is the sector that took us down. Chip stocks are starting to make their move to the upside. Very, very strong bullish indication. The fact that volatility via the VIX is declining. I'm hoping all of these things are pointing to a bullish stock market run. There's a lot of short positions right now. If we continue moving higher, we're going to be squeezing those shorts out and the market's going to rally really, really hard. Now, before I let you go, I want to tell you a few things. We had a day trade this week. Yes, a day trade on CF. We literally got in and out on the same day. We made about 24. It was, we got in on 531. Let's see, was it right here? Nope. Right here. We got in right here. We got in the next day. Literally got in the next day. We took a nice little 24.21% return. It was a day trade. We literally held it this day. We got in the bottom and we got in out at the top. It was a day trade. But I want to tell you guys something. Our win rate on our discretionary programs, we took a total of, since October 1st, we took a total of 144 trades. We have a 77.78% win rate on our closed trades. Our average return net is 4.66% in 21.90 days. $1,000, every $1,000 you invested would have turned into $6,800, and our profit factor has been 1.30 since October 1st. Don't ask me how I do it. Now, folks, next week we've got a lot of Fed data, and we are very near crucial resistance levels. And if volatility drops and if these sectors go up, we are going to be in a good position. Now, most traders do not realize this, but there are stocks that tend to thrive when the Federal Reserve raises rates. And these stocks are making all-time highs right now. I call them super stocks. They're not companies you'll hear about on Fox Business or CNBC. They aren't stocks your friends are talking about. That's why I put together a short boot camp video that reveals everything you need to know about my super stocks. But don't wait to watch these super stocks. Don't wait. They're cheap right now. They're real cheap right now. There are bargains out there. I mean, Fed just started tightening, so there's still plenty of meat on the bones. Follow the link below and find out exactly how to spot these super stocks. Do it right now. And don't forget, Monday, weekly outlook, biggest threats, biggest opportunities. I really want you to watch this super stocks bootcamp. It'll show you 4 major factors that cause a catalyst for stocks to move up. and it's been back tested and battle tested many, many years. You want to check it out. It's great weekend boot camp material. It's all meat and potatoes, no fluff, no monkey business, all good stuff. If you guys like this video, post comments, feedback, and send me love letters. Support@marketgeeks.com. Have a great weekend, guys. I'll see you Monday back at my office. Bye.